JPMorgan revenues of $32.3 billion. That beats estimates of $30.5 billion. 450 is the EPS. We'll make sure that's comparable to the estimate 310, but it does look like a blowout for shares of JPMorgan. Valued probably at the richest valuation on a price-to-book ratio compared to all the big banks, but widely regarded as best in breed, Joe. We'll see how the stock reacts to this. Of course, banks overall, nice run up into the results.
Not reacting very well so far. So if it's
we'll dig into the numbers too, because there are a lot of numbers to go through.
That's why I was giving you some time, because I saw the 450 and the stock down, so it seemed to be so much better.
We just want to bring the headline, as much as we know, and then we'll continue.
Okay. For more on JPMorgan's results, let's bring in Stephanie Link, Chief Investment Strategist at Hightower and a CNBC contributor. In seeing the flashes, Stephanie, the stock has had a good run. And anything that would have been surprising in terms of disappointing investors to explain it? 1%, it could be up 1% next time we check on it. So I'm not saying that necessarily is something in the results. But what do you make of them?
Yeah, good morning, Joe. So for first and foremost, let's just put everything into context. For the banks in general, a couple of things that we're all expecting. Really big, large reserve releases. My suspicion is that's how they actually beat the number on JPMorgan side. But in general for the banks, expecting almost $6 billion in reserve releases. That's a 15% help to earnings, right? But at the same time, you're going to see slow net interest income and net interest margins still depressed. We'll see that recover into 2021 and 2022, but it's still going to be depressed this quarter, this go round. Fees are going to be terrific, corporate capital markets rather, and corporate banks, pipelines, mortgage refis, that will all be very strong. And then pre-provision net revenue, that's income before you set aside bad debts, should be pretty good. But again, I think you're going to see very good beats because of the reserve releases. So I think it's all about guidance. And this, you're right, the stock could be up one, it could be down one. It's had a nice run. It's up 21% year to date. It's up 62% in the past year. But guess what? This thing is trading really richly, I think. 1.9 times book. And so the expectations are very high.
Some more color here in terms of what is comparable, because we did want to make sure 331 X items is comparable to the 310, so still a beat on the EPS, but smaller than what the headline number implied. $5.2 billion in net reserve releases. So to your point, in terms of the release of reserves in order to get to that number, this could play a role, and that would throw into question, of course, the quality of this earnings beat. What do you think?
Yeah, and that's exactly right. No one pays for reserve releases, but it means you have excess capital. It means you're going to be able to buy back a heck of a lot more stock, right? And they're going to be able to increase their dividend when they can at the end of June. And so I think, it's like it's like not a bad thing to have reserve releases, but we just don't pay for it. But then again, we are going to see these big beats. It will lead to eventually more capital allocation. And I think that's really, at the end of the day, one of the positives for banks, right? You're getting a pretty good valuation, maybe not so much on JP because it's expensive, but you're getting pretty decent valuations on banks, and then you get buybacks and you get as well dividend increases, and clearly as rates go higher and the yield curve steepens, that's positive for the banks.
Do you own JP?
I don't. I own a bunch of other ones. I own Morgan Stanley. I own Wells Fargo, which is later this morning. I own American Express and Bank of America. On the rate call, if you want to have exposure to higher rates, Bank of America is your biggest exposure there. Morgan Stanley, I just really like because of the M&A strategy that Gorman has put in place, and they're really diversifying their revenue stream. And they are less dependent on a yield curve, which I don't mind, quite frankly. And Wells Fargo is a turnaround story, and we'll hear what they have to say. I expect that quarter to be pretty ugly, but I want to hear about progress on their turnaround.
Shepard Smith here. Thanks for watching CNBC on YouTube.